You want me to kick it off? Or
Yeah,
you're all right.
we should be live now theoretically, but I don't know. All right, now we're live.
All right. Good morning, Cody. Thanks for hopping on the call. How are things today?
Things good? Yeah, another day. Hoping to get my formal sign off so I can go sign papers for my refi. Fingers crossed. If it's not today, then it'll be Friday, signing Monday or Tuesday, but getting it done.
Awesome. I love it. As you can tell, I'm in a cruise ship today. So a good thing the Wi-Fi is strong enough. We're able to do this YouTube live. And I was texting with you before the YouTube live. I was watching one of your previous videos earlier in the week. It's one of your, I think you do Tuesday, Thursday updates on your business. And the specific video was talking about amortizations and cap rates. And what I always like about you is you have a different perspective of things, right? And you say this term, you say rate factor a lot, which is talking about the cost of money. And it's something that I have not been paying attention to, at least in the way that you do, but just because I didn't learn that way. It's something you learned when you started, and it's really helped you grow and scale your business. And so I shot you a text message saying, this kind of really changed my mind on how to look at things. And really, if we're going to simplify things, because simple is better
Mhm.
for the average investor, it's just talking about margin or spread. Can you walk us
Yeah.
through that in for the layman person that's watching this and how they can apply that?
Yeah, well, the video I went into some depth on, but the idea is you have to be able to compare things apples to apples. And a lot of people just look at yield, or they just look at, another way of putting that is a cash on cash return, or they just look at what's my debt pay down. That's not enough for me. I don't think that should be enough for most people if they're going to get into
Right.
real estate. Maybe not on the first deal. Maybe you're not going to understand it all completely. I know I didn't, but it should be something you strive for. How do we get to the answer? Why does the
Hmm.
calculator say it's 7% cash on cash when it's a 6% cap rate? Or why is it
Hmm.
a 4.5% cash on cash when it's a seven cap? And people don't know.
Hmm.
So
Hmm.
that's where I spent a lot of time and dug into it a little bit on my video about getting to apples comparisons. And the one for the debt cost is called a mortgage constant. I call it a rate factor because that's what it's called. But my lender buddy, who owns a lot less real estate than me, promptly corrected me and said that I was wrong. I was like, turns out I'm not. But, teach their own. There are different ways to say the same thing, which is the most important
Exactly.
thing. You understand the concept. It's your annual principal and interest divided by the loan amount
Hmm.
at origination. So it's like if I have 12 months of my payments for principal and interest divided by my originated loan amount, that would show you your cost of capital. And the idea is you have a cap rate in one hand, which is a dividend expressed in percentage. If you do that equation, you get your realized cash out of pocket cost of capital
Hmm.
in the other hand as a percentage. And so now you can see, is the cost higher or is the dividend higher? And we just have to do
Exactly.
some logic testing and say, I want my dividend to be higher than my cost or my cost to be higher than my dividend. And I pick the
Hmm.
dividend one. But this is why people are struggling to get leverage in certain markets. This is the reason why places like Seattle, you can't do a lot of cash out refis at 80% with commercial, whereas you could do it in the Midwest because your cap
Right.
rates over there are higher typically than your cost of capital. And so you can actually lever up more. You're making money on the spread. If the cost of capital is 8 and your cap rate's 4, you can't borrow a lot of money because you're
Hmm.
losing 4% on every dollar you borrow. So that's why there's markets like Seattle and California where max leverage doesn't work unless you get
Hmm.
creative.
Yeah, it's almost the inverse. Uh, it's basically saying, little to no leverage is the only way to cash flow. Um, Specifically, we're talking about the coastals where the cap rate's lower, right? So I like the concept of this because when I'm talking to other people about investing, whether it's somebody who's a client or somebody who's starting to invest or they want to invest out of state, the number one question is this a good deal? And what Cody's describing there is how he processes in his mind what's a good deal to him. If his cost is here and his the benefit of borrowing that money is here, this is what makes a good deal. This might be good, the bigger the margin, the greater the deal. That's how Cody's factoring it in. Now, for me, I would always run everything on cash return. How much did I put in versus how much did I get out on an annualized basis? Um, Everybody has different metrics on what they're doing. But the key here is you understand what's a good deal for you and you exercise on that. Now, over time, you can change that, right? You could do a different metric, you can do a higher metric. And that's kind of what I learned as I was going. Is like I was doing cash on cash return, which, all these back in 2017, like cost of capital is really low. The On paper, the margins are really high, meaning the cash flow is really high. What I realized on these old properties that the expense ratio is much higher than I had estimated. So over time, like I was changing my expectations on cash return actually lower. Now, why lower? Because my expense ratio, what I was putting in at 10% was coming in at like 20%, depending on the property. It could even be higher. So it's changing and updating the parameters over time is the key thing. And I know when Cody has been thinking about it, talking about it, internalizing it, talking to lenders for 6, 7, 8 years, however long you've been in this. So it can seem very confusing, the terms he's saying. But I texted Cody and I said, the very simple way to put this is like if you're building a house. I'm working with a client, they're looking at this property, they're trying to build 4 houses on the lot. At a very simplistic level, if let's just use easy numbers, if it costs you $100 to build and you can sell that $100 per square foot to build and you can sell it for $200 a square foot, that spread of $100 is positive, right? So yes, you would build, and in theory, you would build as many square feet as possible because every square foot you build, you make $100, right? Conceptually, that's the same thing Cody's doing. The difference is instead of dollar per square foot, it's a dollar he's borrowing. If he can borrow a dollar, and in his one example was borrow a dollar and he has to pay $4 or 4% for that dollar, but he can get 8% back on that dollar. I mean, Cody'd probably go infinite leverage, right? He's making uh, a high percentage return on every dollar he's doing. Anything else you want to add on the that thought track on investing related to margin?
Well, I can show an actual example if you'd like.
Yes, I'd love to see it.
Just getting there we go. All right. So this is on an actual deal that I'm doing right now. This is the one I've been telling you about for however the heck long.
Hmm.
Let's see. Zoom, share screen. All right. So here we go. So this is just a simple deal. I have 39 unit
Hmm.
with, I'm going to round down to the nearest 10,000 just for simplicity. It's a little better than this.
Hmm.
But in this scenario, the NOI on the appraisal, which is what matters to the bank, it doesn't matter what you run it at. I can run it higher and they don't care. They're going to underwrite it. So they're underwriting to a $250,000 NOI. I bought this building for 2 million. Today I owe 2.47 million. So I've grown the value and the income up quite a bit.
Hmm.
Well, the value for this, they appraised it on about a 7 cap. And again, I'm rounding for the simplicity of a video.
Hmm.
So it's about a 7% cap rate on the deal. My interest rate's 5.8.
Hmm.
So if my cap rate, which is a dividend, I think I spelled that wrong, whatever. Dropped out of college. If my dividend is 7%
Hmm.
and my interest rate's 5.8, people would say that you have a 1.2% spread.
Right.
The problem with that is that you're not looking at the actual equation for your true cost of capital, the rate factor, as my buddy called it, the mortgage constant.
Hmm.
It's your annual debt cost divided by the loan amount, which I did right here. So monthly payment, I annualized it by multiplying it by 12. These are two options, 25-year and a 30-year.
Hmm.
By the 30-year AM payment by 12, you have $190,000 a year going out. That makes your cost of capital, if you divide that into the loan, and that's all I did here with the spreadsheet,
Right.
7.041. So you'd actually lose 0.041 on every dollar you borrow. Doesn't sound like a lot, but if we look at the actual margin, if we put the margin down here, we just do this right here. But we can see how much money we're losing on the debt. Just take the lost margin, multiply it by the debt amount, and I'd be losing $1,100 by borrowing money. On that borrowed portion,
Right.
which is not great, right?
Hmm.
So that would make my cash on cash return or my cash on equity return actually lower than the cap rate. So you just have to do the actual math.
Exactly. So in this scenario, the gist of it is like this doesn't make sense to do. So you either need to one, lower the rate factor, two, increase the cap rate, or
Like
like the
it could make sense to do if you have more NOI left in the rent roll or in the property,
yeah.
expenses. I'm doing a cash out refi, and so I'm actually pulling money out and I'm lowering my interest rate from 6.8 to 5.8.
Hmm.
So it's a better, I owe less, so I'm actually pulling money out and my total interest is going down and my cost of capital is going down, but it's on a bigger number. So I have it on a 25-year AM. So
Hmm.
this is my actual margin.
Hmm. So the thought here, let me, if I'm understanding you, it's based, just for rounding, it's almost equal, right? Your cost to borrow is what the value you're going to get out of it, right? So the margin effectively is zero, but you're taking said money, whatever net it's going to at the refi, you're going to go put it into something that has higher margin. Is that
Yeah,
the plan?
that is the plan. However, this whole equation is just, again, like I mentioned in the beginning, it's the how.
Hmm.
Coming up with a yield or coming up with a debt pay down is not enough for me. Understanding how it works is. So when this is the thing people don't get. Even if you have a loan, you're paying cash for every deal you buy. It's just not your cash. And so there's an associated cost, meaning that the cap rate, the dividend is, that you're going to get that cash on cash return on your down payment.
Hmm.
So in this scenario, I mean, I own it, but if I was purchasing it, my down payment would be the difference of this and this, right?
Right.
So what's my yield going to be on that? Yield on down payment. It'd be 7%, right? Because I'm paying cash for that portion of the deal. Are you tracking with me? This
Yep.
is where people get lost, but it's super important to understand. So you're paying cash for every deal you buy. Just a big portion of it's typically not your cash. So there's going to be a cost, which is this or this, right? So since I paid cash for this portion of the deal, this is your cash on cash return. When you pay cash, I paid cash for that amount. So I'm going to get a 7% return. So my cash flow is going to be 61,000 on this amount. And here's the problem. This is where people's returns either go up from the cap rate, the 7% in this situation, or down from the cap rate. The yield on the debt, well, our yield was negative. So our actual, let's put it here, net cash flow would be the sum of these two numbers.
Right.
61 and $45,000. Now, if I did this correctly and I didn't butcher it live, this number plus this number should equal 250,000. Oh, wait,
The
that's negative.
opposite.
Oops.
Yeah.
Yeah. So that's how math works. That's how it actually breaks down and gets you your return. And because there's a negative yield on the margin, what's our
Hmm.
cash on cash return, or what a lot of people like to say is yield? $45,000 divided by the down payment, the actual equity. It's a 5.18% return. It went lower than the cap rate
Hmm.
because we have a negative margin. And this is how the margin's expressed. This is how everybody's mortgage calculator works when calculating a cash on cash return if it's built correctly. So
Exactly. Another way to say that is a weighted average return on funds invested, meaning you have a positive margin on the cash you put in. You have a negative margin on the borrowed debt. When you weight
well,
those
it's not
together,
even
that's where you
margin
get it.
on, yeah, but it's not margin on the money you put in. It's just like it's a dividend. Like you invest money, you get a dividend based on the dividend of the deal.
Right.
The only margin you have is on the debt that you put in place. But you're absolutely right. And so that if people can grasp this, they can see, should I borrow a bunch of money? Do I really want to borrow a lot of money to lose 0.58% on every dollar I borrow? No, not really. But if this number was positive, like if we had an eight cap, right? Like now we have positive margin. So now I want to borrow a bunch of money.
Exactly. And I
Now
think
my
that,
cash return explodes up to 9.28.
right. It's because you're making a positive spread on the money you're borrowing, so it's increase and it's a greater proportion, right? Because 871 divided by the 3.5 is what, 25% or something like that. So you're
Yep.
borrowing 75. What's your loan to value on this?
It's about it's about 25. Yeah. All right, it's about 75. I think it's 76 actually on the appraised value, somewhere in there.
Yeah,
Yeah.
basically 25%. So the key to follow along, the people who are watching now, the math people are loving this, right? We're getting into the weeds. And the beauty of this is that when Cody fact checked his net cash flow, that 45,189, and he added that to the annual payment and tied it out to the NOI. That's the beauty of math. There's only one right answer. These are all interconnected. And what Cody's doing here is understanding what are all the drivers that go into making a decision. And that's one thing that I think that you do, probably better than uh, most of the investors that I'm connected with, right? It is that you're understanding every different variable, how that goes into your investment, and why you're making a decision, right? And this goes into Cody, like a couple live streams ago, went over a project that was, I think, a couple years old, right? But Cody had logged all the numbers still to where he could intimately talk about that deal as if he was doing it right now. And usually that comes from understanding the numbers. And that's what I've seen and other investors do is that they're not necessarily a numbers person. They fall in love with the deal because of whatever. Great location and so much upside. You start asking them about why did you make that decision? There's a lot of letters and not very many numbers. And at the end of the day, the numbers are what actually make a good investment. So if you're following along, this type of analysis is what's required in a market we're in today. Now, a couple years ago, you should always know this. Now, a couple years ago, things were stacked in our favor. The market was going up. We had flat to down and low interest rates, so everything was in our favor. So a lot of people were carried, right? Now, in today's market, there is no carry. If you do something wrong, you're actually going to get instead of getting carried up, you're going to get pounded into the waves, right? So,
Well, you're gonna get whacked because back then you look at costs of capital, right? And I can go back to the screen share. What people were borrowing at was ridiculous. So if we just do a little payment calculator, so let's say what were the rates back then? Four
and I was 3.5 was majority of my debt from
Oh my gosh.
2017 to 2021, probably.
On a 360 payment schedule, it's a 30-year AM. And then present value, let's do $1 million.
Hmm.
Okay. So that would be your payment. If we're just going to do the same exact, like if we copy and paste what we did over there, right? Times 12. So that's our
Hmm.
annual debt. I'm just going to move this over so people can actually track. Do that, copy and paste. Thank you, Excel. Let's take this divided by our loan amount
A million.
and $1 million. Make it percent. So we're sitting at a 5.4 basically cost of capital. So if you bought north of a 5.4 cap, you could do an amortized debt product at 3.5 and you would make crazy amounts of margin. Like it was stupid. If you could buy a 6 cap or 7 cap or an 8, you're
Hmm.
making all this margin. And people are doing IO too. Like there's so much commercial where you could get 3.5%, 4% interest only. You could buy at a
Right.
4 cap and have a little bit of spread. Crazy. So
Oh
it
yeah.
definitely bailed out people.
Oh, 100%. And then they would do that and then take that money out and then roll it into another one. So just kept that debt cycle rolling up. And I know I did the
If
same thing. You know,
I would
you.
do the same thing today, if I could get 10-year fixed rate, interest only debt,
Mhm.
I would rip out as much money as possible, especially with a cap rate of 7.
Exactly. Now, are you, speaking of that, most of my, I would say maybe 80% of my debt when I was at the peak was commercial, 5-year fixed, right? Which is standard. Are you seeing lenders do longer terms now? The assumption is rates will drop down, so they're probably okay. Hey, yeah, you can borrow more money for longer in today's environment. Are you seeing that, or are you still getting 5-year fixed debt on your commercial?
Oh, on some of the products I'm doing, it's like a 5.5, but
Hmm.
you can definitely go longer.
Right.
I'm trying to get so the townhome site that I have, I really want to position that to be a HUD loan product because then it's 35-year fixed, never have to think about it. Like that would
Right.
be talk about ideal.
Yes.
So
That's one
that's what
of
I want
those
to
like
pursue.
you could do that one deal and in theory retire off the one deal, right? Because
Because
it only gets better
it's
over time.
well, yeah, and it's like Dion, right? Long-term fixed rate debt. I'd have one location. I don't have to think about it. He
Hmm.
wants as long of amortization. I'll actually have longer amortizations than he will on his. So
Right.
I'm pulling a Dion is the plan.
Exactly. I love it. Perfect. What else? Is there anything that you're doing on your analysis that we didn't talk about today, specifically the rate factor? And I'm glad you showed this rate factor kind of real time because historically, we've been doing these lives for maybe 6 months or something now. And, because I'm not used to the term rate factor. So,
Mhm.
but now I'm getting used to it and like how you're showing it. Is there anything else like that you're doing, i.e., this rate factor, that you use in your analysis that you think other people aren't using?
I think people just don't understand how they're getting to the answer.
Hmm.
So I'd encourage folks to really dig into it. Most lenders don't know how to use it, so
Hmm.
it makes you feel better. The people in that space don't even know it. I
Hmm.
brought that up to many lenders, and only a couple have actually known about it. So it you can build a successful business without using it.
Hmm.
But if you really want to understand why things work the way they do, which is something that I've really wanted to get a grasp on, then you should dig into it because like we saw in real time, everything's zeroed out. Like it works. It's the math,
Hmm.
and it's going to be the same math no matter how many times you do it. it will always zero out if you're doing it correctly. So if that's something you want to do, then really dig into it, get a grasp on it, understand one is a realized cash out of pocket cost, and it's important to try and minimize costs where you can,
Hmm.
either driving the amortization out, going to IO for long periods of time, or driving the rate down. There's different ways to do it. But if people learn this, that is the how you get to your answer, which is something I never wanted to do in elementary school. My teacher's like, show your work. I
Exactly.
hated it. Now love it because it's real. It's super helpful to know.
Yeah, the other thing that I'm assuming you do this as well. I'm big into Excel, and when I'm doing seller financing offers to sellers, like sometimes I'll do three offers to them, like and I'll adjust the different terms, and then the model will kick out how much money is invested, what's the cash on cash return in each of these scenarios, and I typically bookend it. There'll be the highest cash down, which typically is the lowest price. And then it'll kind of, if they want interest rate, it'll be potentially, typically it's a lower amount of down. And so I do these different models. And then, because I'll get to a point where we can do like a couple different options. And on my side, it's roughly the same return. The only difference is on their specific side, what best fits for them. Do they want more money today? Do they want the highest price? They want some sort of tax benefit, whatever that thing is. So by doing these models, you're adjusting all the variables to see what's the most sensitive and how you can use those variables in your favor.
Yeah, and you can look at combined cost to capital too. So in your situation, one of the offers could be 95% seller finance, 5% down, whereas the seller's financing 85% in first position at 4%,
Hmm.
and then 10% in second position on a second note at 11% or 12%. And because now you get to put the blended rate together, you can look at what's my blended cost of capital. You could probably get that below the cap rate. And then since you're putting 5% down, your return explodes. Now you're in the 20%, 30% plus cash on cash return. And that's something that I've definitely done before that works.
Exactly, because if you try to get the whole thing at a lower rate, that can be a hang up for people, right? And so by having the second one, it can be a fairly nominal amount. Let's just say you're borrowing 1 million, right? And the second's only 50,000. So you have 950, let's just say it's at 5%. And then you have 50K, let's say it's at 10%. And you're like, well, I am paying you 10% on this second position,
And
right?
some
Now,
people would say, well, why would you do two notes? Why not just get the blended rate to be the same? The reason is because you can have different balloon periods for those notes. So that
exactly,
50 in that example could be due in 3 years, and then the 950 could be due in 10, right?
exactly. So, and then you're always trying to set the structure of the deal up in your favor, right? And so and they might, because typically they want more money now. So you might do a smaller portion, higher rate at a shorter level to get them to do the deal. But it's not detrimental to your overall plan for the project. So, but it comes down to the same thing. This whole 30 minutes that we've been talking is understanding all the variables in the project. The better you know it, the better odds of you being successful in that project.
Absolutely. All righty. Well, should we wrap for today? Get you on
Let's
your
wrap.
boat cruise.
Yep, we're off to probably going to be doing dominoes for the next couple hours.
Have fun.